My next guest is staying bullish. Let's welcome in Mark Avallone, president of Potomac Wealth Advisors. We brought back Dominic Chu here as well. Mark, I absolutely thought of you when we spoke a few weeks back about how you were bullish on defense, because soon thereafter we had the whole Kevin McCarthy fight. Has that diminished your bullishness at all?
Well, no, not really. We saw a little bit of a pause in the sector, and that's to be expected. But with the Democrats so behind Ukraine and Republicans, the vast majority of Republicans supporting defense, our view on government spending for defense isn't going to be skewed by a minority in the Republican Party. It's also, our view is also bolstered by the unfortunate headlines that we see. The export of drones to Russia from its allies is creating a demand for the air missile defenses that our large defense contractors make, the ones that dominate the ITA.
Dom, what would you add?
So I would say this. The issue for many of these defense contractors, especially the so-called primes, the one who do most of the work for the U.S. government, people like Lockheed Martin or Boeing or Northrop Grumman or others like that, General Dynamics, which makes the M1 Abrams tank. The issue becomes how much mass or how many orders do you need for it to really move the needle and really be that huge tailwind benefit? Because as you point out, over the course of the last 12 months, we've seen a massive surge in many of these defense stocks tied to this kind of optimism. I mean, optimism is a weird word.
Right,
tied to the brighter outlook for defense spending because of geopolitical risks. Now, if they were to come to fruition, if things were to escalate, then you might start to see almost maybe a bipartisan agreement to say, hey, maybe we do need to spend a little more on defense going forward. So that could be something to watch as well.
And that, Mark, was your point, that, you know, the Ukraine issue actually got Democrats around to the idea of increasing defense spending, which they had traditionally been a little bit more reluctant to do. Could you also then give us your kind of, like, put this into context of the broader market? You know, as we sit here having kind of a risk-on January, while the data gets worse, we're talking about debt ceiling and you know, escalation overseas. How would you be positioned more broadly?
Well, that's one reason why we like defense. Unfortunately, global risks are one of the biggest outlier macro risks, and that is one way we protect the other parts of our portfolio, which are under pressure. Look, we saw a real weak computer consumer number out of Microsoft, and that tells you that's a harbinger of a weaker consumer at the result of the Fed and their action. So that's why we want to be broadly diversified here. I don't think you exit tech just because of the Microsoft report today. We are concerned a little bit about the Justice Department on Alphabet, but generally speaking, in a slower growth world, we want to own growth stocks because that's where top line growth would be. And we would pair it with other sectors that might do well in a volatile environment.